Good evening, everyone, and welcome to another webinar today powered by Century Financial. And today's topic is psychology in trading. We will talk about today the behavioral biases and how emotions can affect a trading call and how emotions can affect a strategy of a trader. And when I say trader, it does not just means that somebody who's doing buying and selling, but also these biases or these psychological biases, as I should say, also go beyond trading. It goes to in a long-term investment, any decision you make in life. These biases, they always affect you, they always have that impact, and that's why it's really important for us to understand what are these biases and how you can actually control your emotions when you are investing somewhere, because money, wherever money is involved, it's going to always have a big deal. So once again, most welcome. My name is Yogesh, and we keep doing webinars like this every week. It's different topics. Sometimes it's about trading strategies, sometimes it's about psychology in trading, sometimes it's also about understanding where the market is going. Sometimes it's about central bank decisions, sometimes it's about economic or fundamental analysis for technical analysis. The idea always is to keep our investors informed, updated about what is going on. Please let me know if you can hear me properly. You can use your chat options to type and ask me questions, any questions you have regarding the topic we are discussing today live. Please ask any questions if you have. I will also be logged in side by side to our live trading platform. So if you have any questions regarding that as well, please do ask. Although the topic for today is psychology in trading, and at the same time, we are going to talk about how moving off the markets, how market movements, they impact our investment behavior, and they also play with our mind basically. And that's why it's really important for us to understand, to know that how psychology in trading exactly works. And over a period of time, we have seen that trading psychology is not something, it has emerged now. This has been there every throughout the time. We have seen it's basically the way you're approaching, you basically the way you think and you feel about the stock market, the way you feel about your trades. That is your market psychology, because that is what affects your behavior in the market. And the way your behavior gets affected, exactly how your trades turn out. So it affects your trading performance, it affects how you behave in the market, and it all depends on how you feel about the stock market. So the psychology of trading is all about the approach you do in trading, and that in turn affects your trades, it affects your performance. And obviously, because money is involved, so it does affect your life as well. So apart from the technical aspects where risk management is involved, when to enter, when to exit, what really matters is your psychology of trading. Because technical perspective, managing your risk well is one part, but how you actually, what's your approach towards trading is what also is really important. Now you might be a very experienced trader with absolutely good knowledge, great certificates, you probably have great trading skills, and you have taken profitable positions in the stock market. Still, if you also let your emotions cloud your decision making, you can end up facing losses. And I think this is tried and tested by every single person I know. Many people who have record of generating profits in the market, the moment they allowed their emotions to come in, they always faced losses or it didn't go in their favor. And to be a successful trader, I think first and foremost, to become a successful investor either, you need to recognize your emotional biases. And to, if I had to broadly define the foundation of all these biases, it's greed, it's fear, hope, I should also say panic, for example, euphoria. This all combined together is the foundation of all the behavioral emotional biases you have. And the majority of the traders, they spend a lot of time, they spend a lot of energy and worrying about which way the market will go, whether they will make a profit or loss, and this leads to a lot of stress. So they end up buying at the wrong time, they sell up at the wrong time, and as a consequence, whenever you are entering, even if you're a successful trader, it basically affects you. And you want to be a successful trader, you have to understand that once you have entered into a trade, you have no control over its outcome. You entered and that's it. So instead of worrying about gain or loss, you have to work hard to find out a trading strategy. You have to fine tune a trading strategy, right? So please ask me any, as I said, if you can hear me properly, please write yes or okay. If you can hear if you can see my presentation, so I can continue this session. And you can test your chat options also, just in case if you have any questions you like to ask back on your past experiences about investment or anything, please go ahead. uh, I've kept the video open just in case, but if you feel that there is a network congestion, I can switch it off. Sometimes it happens due to network, and due to the video being switched on, it might affect the quality of the call. So just in case if you feel that way, please let me know. Use your chat options to write it, and I'll do as per required. So I think a lot of you have already started writing yes, okay, okay, okay. All right, okay. Perfect. Okay, great. So I'm assuming that everybody can hear me properly. That's great. We have a lot more people joining in, but then I'll start anyways. Perfect. So as I said, that there are a lot of these behavioral biases. There are a lot of these emotional biases which impact us. And trading psychology, as I said, it's that approach which allows us to define what stock market is for us. So you also have to understand and define that what stock market, how you see stock market, right? And we are going to talk about these biases. We are going to talk about how you correct them, because that is also something which is really important. Financial literacy is one of those things, because to have enough understanding of financial markets, you must have to have intelligent investment choices. And the investment choices are also affected by the biases. There has been a lot of research which is done, and you will see in those research that a lot of times investors, they choose choices on the basis of their emotions. And that's where we have to understand that you must invest in an asset class because it's the right thing to do in terms of risk and returns, not because you have a gut feeling about it or you have a hunch about it. That has to have a basis of it, right? So let's try and understand how exactly the psychology in trading works. So managing the emotions of a trader, it's one of those things, because psychology, as it shows in the presentation, plays a very important role in trading. And as it does in any game, whether you are playing football, tennis, or any sports, your psychology has to be aligned with your objective. You want to excel in any part of the area. As I said in the beginning, that emotions is not something which helps us to invest better. I'm sorry, managing emotions helps us to make to invest better, but managing your emotions also helps you perform in every aspect of your life, whether it is sports, whether it is work, whether it is investment, even maintaining your relationships. I mean, I'm no one to give an advice on relationships, but even when you are managing your emotions right in a relationship, it allows you to absorb and have a clear channel of communication between you and the other person. And that's why managing emotions, especially in investment, is really really important. Because, and there are different ways to do it. Like if I would have one way of controlling my emotion, that would just never work. So there are different ways you can look into. And as we know that by very nature, we are naturally very emotional people. Humans are very emotional, and we have survival instincts. And then obviously we have our strengths and weaknesses. So what we have to understand is that from our emotions, we have to separate emotions. We have to separate our survival instincts. Survival instincts are those reflexes which actually allows us to excel in a lot of areas. If we are stuck somewhere, we have survival instincts, will grow, will go out safe. But if we are too emotional, even our survival instincts won't work because our emotions, they overcome that. So separate your emotions from your survival instincts and identify what is your strength and what is your weakness. In terms of trading, for example, what is your strength? Are you a person who read a lot, or are you a person who just look at the charts and technicals? If you are the person who just looks at charts and technicals, then most of your trading would be short term. Because to have a long term investment, you have to read more, you have to have a fundamental perspective of, okay, I'm going to invest in this stock for 2 years. So I'm not just going to invest it because I'm a good chart reader. Just because chart allows me to buy it here and sell it here, I'm not going to buy this stock. I'm also going to read about this company. I'm also going to understand the balance sheet of this company. I want to understand the competitors of this company, what product they are going to come up in the next 5 years, and how the competition is going to perform. So you have to identify what is your strength and weakness, what sort of a trader you are. Identify yourself. Most importantly, what's your risk appetite? Can you are you a person who can see red in your portfolio, or you are loss averse, or you cannot see loss at all? Are you a sort of trader who would quickly book profits but hold on to the losses and get it accumulated, right? So you have to understand where you are going wrong. And identifying strengths and weakness, it's not that difficult. uh, when you are entering into any product, as I said, that I'm definitely going to help you also to understand that how you can manage your emotions while you are trading or while you are investing. And that is something which is it's not a very new thing, but then we always talk about this in every aspect of life. They always say that don't marry your position, right? Which means that if you have entered into one trade, you don't have to marry one particular asset class, because it's very easy for a trader to get stubborn, right? Hold on to the trade just because I hope that it will turn around. Now that's a problem, because if it's a bad trade, you have to close it down as soon as possible, take your loss and move on, right? You have to prepare a journal where whatever is your next move, you can write it down. So every single time, you should never marry a position. You should never hold on to a trade just because you hope it will work out, right? uh, Always see, this is one. The second thing is, we always confuse ourselves, like whether we are prudent or we are fearful. You want to trade wisely, you want to trade in a prudent manner, you want to use logic and you want to use reason, right? But sometimes what happens is, this may make you hold off a trade, because sometimes when you are giving logic to your trade, or when you are logically thinking, should I invest or not, sometimes you may not know, but what you are thinking as a logic could be your fear. So you have to make sure that your logic, your prudence is not the fear behind your decision. Because if you're scared, then that can wreck your trading by keeping you from making that trade at all. So if there is an opportunity and you feel that you have taken a logical decision not to pursue it, and if you have to confirm this, that whether this is your logic which is talking, or this is the fear which is talking. And there is no device to measure that. And I think that all of us inside know that when we are taking a decision, is it logically we are arriving at, or we are just scared of that. So I think that is something which you have to take, because every time, and I'll tell you a very live reason for this. So since we are talking about it, I'm going to give you I'm going to share my live platform also while we are talking about it. Just see this. Can everybody see my platform here, or you want me to zoom the screen? Just a simple yes or a thumbs up would do. If you can see the platform right, just let me know. So I just want to make sure that everybody can see the screen. I'm just switching through it. Just 1 second. Yeah, can everybody see this? Just send me a yes or a okay. That would help me out. If you want me to zoom into the platform, I can also. Just let me just switch on. Let's take US 30 for example, which is Dow Jones. It's a US stock market index right here, and I'll show you the example of what is prudence and what is fear, and we're going to take a trade on the basis of that. Yeah. So I'm assuming that everybody can check. Everybody can see my screen right now. Perfect. Okay. Yes. 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 Oh. Okay. Get it. Okay. I got 15, 20 yeses. I'm assuming. So those who are not able to connect or have to leave this in between, don't worry about it. A copy of this session will be put on YouTube as well. Just doing live actually allows you as a attendee to ask questions live and go through this, so it's up to you, but otherwise a recording of this will be put on YouTube sooner. Now right now what you see is the price of a US stock index which is called Dow Jones. Now if you see the chart of Dow Jones right here, I'm going to show you a very short term chart. Last thing I can say since morning, if you see this, here the timing is around 6:30, so I'll go a little more out. Now here the timing is around 6, 7, 8, 8th September, and this is 11th September. So if I see from last 3-4 days, Dow Jones has been moving around, if I'm not wrong, somewhere around this area. If you look at this, all right, somewhere around this channel. Now, ideally, last few minutes, what we have seen, if you see Dow Jones has come around this particular area right here. If you see the chart right here, and then now it looks like here there is a small resistance somewhere around 650. Let me draw the line for you so you can see this very clearly. See, somewhere around this area, 668 or somewhere around 666 right here. Just look here, 666 here. So if you see there is a resistance, so now the prices are reaching towards this. Right now the price is 635, but if you see overall in last few days it has not been able to climb back, but even if it does, it's 660, 670. Now tomorrow is the inflation data also. Inflation is expected to increase since the oil prices have gone up, and US stock index has basically been ranging around this. Ideally, it's probably a good idea to short sell and keep your stop loss above 660 in case the market moves on. Logically is that, but now either I can take a trade and say that logically it feels that it's good to short sell because it's ranging towards it, or out of fear I may not enter into this trade or wait for it to go higher so I can short sell at a higher price. So I have to take a decision. Logically, does it make sense to sell it now or wait for the markets to go up? Now, when I know the chances of market going up are lower given the range of the previous historical record, ideally I should be short selling it and putting a stop loss above that resistance, above 650. But I choose not to do that and wait to see what if market goes up. Now that is fear. It allows me not to take an opportunity, right? So that's where we have to understand that we need to be differentiating between logic and fear, right? Sometimes we say out of logic that, oh, logically it doesn't make sense to enter into this trade. Is it your logic or is it your fear? That's what you have to decide, right? So coming back to what we're trying to understand, that we have to separate our emotions and we have to separate prudence with fear. What we feel is logic and what we feel is fear. Both of them are different things. Am I not entering into a trade because I'm scared, or logically I should not be entering, is what the decision you need to make, right? And then we have to identify our strengths and weaknesses as an investor. Are we good at technical analysis? Are we good in fundamentals? Do we rely too much on somebody else's advice? Do we get stressed very easily? All of these things definitely impact us. Next is the emotional experience and preconscious. Our emotional experience is basically based on our preconscious thoughts and also our previous emotional experiences. Now, see, understand when we talk about how an opinion is formed, right? So, basically, when we talk about preconscious thoughts, exactly what preconscious thoughts exactly are, because when we look at the psychology of our trading, right, and we talk about our past emotional experiences, like our past emotional experiences can be anything. If, like, for example, I was a trader who made money in gold or lost money in gold, so for me, past emotional experience in gold could be happy or bad depending on how we have how I have basically worked, right? So in this case, whatever was my past experience in gold, it affects my future decision also. So I have to understand my previous emotional experiences and what are my pre-conscious thoughts over this particular thing. And we have to understand that every time our uh, pre-conscious thoughts, just to give you an idea how pre-conscious thoughts work, these are basically uh, like thoughts are pre-conscious when they are basically unconscious at a particular moment, right? And you can easily recall them. You are easily, like, these are the thoughts which are capable of becoming conscious. Like, to give you an example, like, brought to awareness, right? Like, for example, you may not be thinking consciously of somebody's address, but you can readily recall it when asked, right? uh, if, like, for example, any thought you have on an unconscious level, that cannot be recalled with effort with a specific time. Like, if you had an unconscious thought and I asked you right there that tell me about this, so you may not be able to recall it right away because it's your unconscious thought, you are not able to recall it. Pre-conscious thought are somewhere in the middle. Like, you may not be thinking about it, maybe you have seen that in the past, but when recalled that data, it immediately comes out in front of you. That's what a pre-conscious thought is. And then there is a previous emotional experience, right? So a previous emotional experience is what you had with something that also forms an opinion about that particular person or particular instrument or a commodity or an investment avenue. And then pre-conscious thought is something which you may not have talked a lot about, but it's in your mind and you can recall it when you are experiencing it. So our trading experience also is made of pre-conscious thoughts and previous emotional experiences. You must have had a preconceived opinion about an instrument like oil or gold, and then you combine it with your previous emotional experience you had when you took a trade. It could be happy, it could be sad, but that determines what you have to do with that instrument, and it kind of forms a opinion about that instrument. Like, how many of you, tell me, actually trade in gold day on day? So right here, if I'm seeing, just use your chat options, guys. Use your chat options. How many of you trade in gold day on day, or 2 days, 3 days, 4 days? You tell me. Okay. Yes. Yes. No. Yes. No. Yes. Yes. some days in the middle fine, right? So what I'm getting from here is there are yeses, there are nos, and then somewhere in the middle I see few people do it, few people not. Those who are not trading, what is the reason? So there could be a reason that you don't know much about gold. If you don't know much about gold, what has stopped you from knowing more about gold? Is it your interest? If it is your interest, then why you are not interested? Why you're not interested? Because you feel it's too risky. I'm just deducing it down to it. Could be any other reason. You may not have time or anything. But if you feel it's too risky, that means either you know somebody who traded in gold, who lost money and spoke to you, so that becomes your pre-conscious thought, or you had a previous experience with trading in gold where you would have lost money, or you gave it to someone to trade and they lost money. But that does not make gold a bad instrument to trade. It's just you need to have more experience and understanding of what you did wrong last time, right? So that is where we have to differentiate. We have to understand that our trading calls, our investment ideas cannot be based on our pre-conscious thoughts and previous emotional experiences, because that's what forms a thought about something. We have to see investment avenues in the most rational way and keep our emotions separately. So that's why our pre-conscious thoughts and previous emotional experiences, they lead to the action. We have to understand that choosing our investment, we have to keep these things away, because not every day is same. Someday market will be higher, lower, someday gold will go up or down, and it will depend on a lot of things. Like alone gold can move higher or lower on the basis of uh, whether your country is going through a political shift, or whether dollar is stronger or weaker, or central bank policy, or pandemic, or referendums, or voting. Everything impacts gold. So you may not say that last time it was exactly what it is. So there will always be a difference. That's why try to separate your emotional experiences, your pre-conscious thoughts. Try to keep them separate when you are thinking about trading or when you're thinking about investing, because normally these are two things which form an action in your real life, and that action, when while you are trading or investing, may not be a good idea. You may not want to take a trading call, or you may not want to invest your money on the foundation of your pre-conscious thoughts and your previous emotional experiences, because it impacts your investment calls a lot. That's why I'm asking you to be away from it. So two things which you've understood, that the action which is normally a result of your pre-conscious thoughts and previous emotional experiences can be bad for an investment. And at the same time, what we understood was that how you can differentiate prudence and fear while you are taking an investment call, right? Your logic and reason should be there when you are taking investment, but then you have to be sure that I am taking this call only because it's logical, only because it's prudent, not because I'm fearful or not because I'm scared. Because fear makes people do things which you may not like later, like you missing out on an investment opportunity just because you're scared. It may not go well in your favor, right? Next, we talk about unconscious emotions. Right now, obviously, we talked about pre-conscious thoughts. We also have to talk about unconscious emotions. Now, when we talk about unconscious emotions, the examples basically, the unconscious mind, if I were to call it, it's like a sea of feelings, thoughts, memories, urges, for example. And this is like something which is outside of our conscious awareness, right? So the unconscious contain contents that are very unacceptable or unpleasant, feeling of pain, anxiety, conflict. So this is something, I mean, to give you an example, um, these are some very unpleasant feelings which we feel. In terms of trading, again, as I said, if you have anxiety, if you feel conflicted, if you feel fearful, these are something which comes within. And as I said, emotion is something which is very innate, it's very powerful, right? And it's basically, as it, you can read here, it's basically human nature to see things with our own personal filter, right? Like for example, how you see life today, it's everybody around you is a supporting cast. You're the main hero of your life, you're the main hero, you're the main lead of your story. This is how we see ourselves. But in somebody else's story, you're just a supporting cast, you're not the actual lead. So we see life, we see humans, we see people around us with our own personal filter. Past experiences, as I said, has nothing to do with trading when you're determining your present approach of trading. Please understand this. I meet a lot of people every time, every day, every year, who come and say that, trading is something which is, I lost all my money in trading, and it's I got addicted to trades. um, no lies over here. I mean, I have met people who have lost all their money in trading, but then somewhere all of these people have one common feature, and that was that they were driven by emotions. Somewhere they allowed themselves not to cut their losses when it was needed. Somewhere they allowed themselves to over leverage their position in greed. Somewhere they allowed themselves to not enter into the right opportunity when it was the right time, only because the emotions, they overcome that. Emotion, as I said, is our present beliefs are governed by past experiences, which are linked to unconscious emotional memories. So that's why we have to understand that we don't have to uh, put our present beliefs the way trading works or the investment works. We have to separate them. When we are doing trades, we have to take a call and we have to stick with it. If we have a loss approach in mind, I have put $50,000 daily, I cannot lose more than 500, period. My loss should not increase more than 500. I should put a stop loss and get out of that trade. If I'm not doing it, I'm hoping that markets will recover, or I am in fear that I might have to book a loss, or I have anxiety. What happens if I lose? All these emotions cloud my judgment. So even I'm the best trader in the world, if I'm not able to manage my emotions right, I will reach nowhere. Now, as we talk about the four wicked enemies of a trader, they're talking about greed. A trader under the influence of greed will always try to go for more profit, never close their trade when the strategy dictates they should. So, like for example, as I said, understand the idea that when you are, so same example right here. See, currently, if you see, right here while we were talking, now it has reached towards a resistance, Dow Jones right here while we were talking. Now ideally, let's see, because there is a resistance at 700, what I'll do is logically I'll allow myself to sell, say, 2 units at US 30, sell in the market, confirm, place order, because it is only logical to sell it here, and also to make sure that I don't lose more than my anticipated target. So I will keep a stop loss if, as I can see logically, that if the range goes above 700. So I will put a stop loss right here, 34,705, which will allow me to lose $58, right here. Modify, done. So now if price goes below 34,675, I will make a profit. But if it goes above 34,705, my loss will be booked and it will be okay. Because logically, I should take a short sell here and put my stop loss above this red line. If it crosses the red line, that I am clearly in the loss and I should be getting out of this trade real soon. If not, the price comes down, I should book a profit around 34,628, because this is where the support lies. So logically, I should get out at 628 and my loss should be booked at 705. This is a trade placed. Now, if I spend my entire day worrying about oh, what will happen to my trade, what will happen to my trade, it's not good. I should not worry about it. I have taken that loss, I have put that profit. Now whatever happens, it should be acceptable. I should have no regrets, right? So this is where we have to understand the difference between, as we were talking about, how we can avoid greed and fear, ego, revenge trading. Imagine in this trade, if my stop loss gets hit, if my stop loss gets hit and I again take the same trade without even checking the trend, which means I have that much amount of ego that I'm not ready to accept that I lost money in the market. I should not. If my stop loss gets hit, I should get out of the market and think, wait for the right trend to form again and then enter. That's why I need to have manageable quantities. I should not increase my quantity. If I increase my quantity, then I will be under fear and I do it out of greed. I will get panicked if the trade doesn't go right, and I will try to take revenge. All of the wicked enemies which you just saw comes into one trade. So, as I said, that never ever take a trade where you feel that you are getting greedy or you are scared, or as I said, never do revenge trading. I have seen a lot of investors, they try to take revenge from the market because they feel how they lost money here. They were not supposed to lose money in this. So they try to take revenge by increasing the quantities double, triple, and they think that they will recover the losses. But eventually, just anything which you do out of revenge, out of spite, out of anger, it doesn't end well. So please try to manage those, especially in trading. Now, to make you understand about how behavioral finance is, so basically the trading psychology, as I said, it's one of those approaches, right? That how is your approach towards stock markets. We also understood about the idea that how you can basically make sure that your emotions don't collide with your logic, right? And now understanding how what behavioral finance is, because that is something, it's a very interesting field of study. And you will find a lot of talk about how behavioral finances actually work, because behavioral finance, it's in last more than 5 to 10 years, behavioral finance has a very important part of fund management as well, because now people have started understanding that there are a lot of behavioral tendencies which need to be studied, which actually impact the markets. In more than multiple occasions, it was found out that a lot of fund managers who have a very good track record sometimes also get succumbed to these behavioral biases. So if fund managers are not biases proof, let alone how the innocent investors will be. So we have to study under the behavioral finance that how many sorts of biases are there. Just the top 10 ones I am discussing it with you, but then there are a lot of biases which comes across. So we are looking at overconfidence, self-serving. Like when we talk about overconfidence, it reflects when investors, they kind of overestimate their abilities or trading skills. And this happens a lot of time. If I do one trade right, I feel that I know how market works. So next time when I'm doing a trade, I tend to do with bigger quantities, take higher risk, and not even think about where the trend is going. I just feel, this is the right way to go because maybe 2 3 times I got it right. So I just become so overconfident that I avoid every single news, every single red flag which comes across my trade. So overconfidence, guys, it's not just in trading. I think in every aspect of life, overconfidence would never be a good thing, because this is where the tendency is. Like there was a 2020 review was published in the International Journal of Management, and we found that overconfident individual investors, they generally do not manage, and they're not able to control risk properly. And this is something which was found, and it's a very common thing in investing. And why it's a problem? Because when you are filled with overconfidence, it can make you as an investor, you can overestimate your abilities now, and that can lead to very poor or very rash decisions. Like, to give you an example, like in investing skills, let's say for example, you will get to believe that you can accurately time the market. Even markets are unpredictable. Hear from a lot of clients that no, no, I don't want to invest right now. Right now markets are performing really bad at the moment, or I don't want to invest right now because markets have already gone up, so why to invest right now? By saying this thing, you're proving that you know where the markets will go. So somebody who tells me no, right now markets are going down, what is the point of investing right now, it will go down more, which means you know exactly the time when markets are going to reverse so you can enter then. Or when someone tells me then right now markets have already gone up, now I lost the opportunity, which means you exactly know that when they are going to come down so you can enter. That's not how it works. Markets are unpredictable. We are living in a very weak form of efficiency in markets. Every single news, every insider news, everything affects market. It's not a strong, efficient form of markets we are looking at. It's very weak. So how can you predict markets at all? You can't. But that's what overconfidence leads to. So that is why it's a problem. We have to take care of this. How you can overcome it, I will also tell you. If you're a beginning investor, you need to consult a professional consultant and get a check on your investing strategy. So whatever strategy you have, whatever trade you take, just verify this with a professional consultant. Just take your alternative perspectives, right? And see, a lot of times you should consider sticking to passive investing rather than trying to time the markets. Like sometimes what happens is, it happens. Like those investors who are mostly doing buy and hold, they tend to be less overconfident because they don't try to time the markets by frequently trading. Now, there are a lot of investors or traders normally over a period of day, they would buy and sell, buy and sell, buy and sell. So because they do so much of buying and selling, sometimes if their level goes right, a lot of times they become overconfident. So while doing this, they sometimes increase the quantity or increase the risk, and then that one big loss erases all the smaller gains. So that's why you need to understand that sometimes diversify your portfolio into passive and active investing. So you don't just become a completely active investor, and you don't just become a completely passive investor also. Now, second thing, while we are looking at biases, because there are a lot of these biases. If you see that there is also something called a confirmation bias, and confirmation bias is also something which is we have seen back in the past. It's something so common because and this happens when investors, they only look at the information which matches their belief. Tell me if you have seen this in you or somebody around you. So many times, if you have taken a trade or if you have taken an investment call, it doesn't matter what information comes in light. If that information is against the trade which you have placed, you will not consider it. Like, for example, if I have bought Apple stocks and today is the launch of iPhone 15, I will always look for positives in iPhone 15. Did you not see it has a 48 megapixel camera? Did you not see it is coming in so many colors? They have opened a 128 GB slot now for iPhone 15 Pro, and it comes with the same price. It's just a better phone, right? Even if the phone is same, small changes in the camera, they did not change a lot of things, and ideally it's no big deal. But because you have bought the Apple stock, you will only try to see more positive in that information than negative. This is called confirmation bias. Because you are so confirmed about a trade you have taken, you would only want to see the news which supports your trade and not hear what does not. And that's a very, very big problem, because that basically means that you are discounting every piece of information which can tell you that you are going wrong, right? So as long as any wrong data, it fits with your views, you will end up relying on it, and that's not the right thing. So please get rid of confirmation bias. And the best way to do is that take all the information and treat it positive. Like, look at all those information, look at all those points which can affect you. So every information should be considered. You should give equal weightage to all the information and then see whether your decision is right or wrong. Correct. So I think that is one of those things which you should definitely look at. And then we are looking at other biases, like for example, if you see hindsight, for example, hindsight is one of those bias which we see a lot of times, and this is one of those things where people say that, oh, I already saw it coming. This is not something which is new to me. Like 2008 crisis, when it happened, everybody was like, yeah, 2008, it had to happen. I could see it coming. But the reality is that nobody saw it coming. I mean, maybe a few people would, but everybody in 2008, yeah, this had to happen. So we have to understand hindsight means that we will still lose, but we will not accept that we lost money. We'll always be thinking, yeah, this had to happen. We saw it coming. So always try to learn from the mistakes. Uh, Similarly, if I show you a few more biases, look at something called anchoring, for example. And this is also one of the most important biases, because anchoring is something which it happens to all of us. And to define, it's basically a kind of phenomenon where someone, like as an investor, you value the very initial piece of information, and that piece of information will become the anchor or the foundation of all the future judgments. So this happens like sometimes when you have to sell or buy. Because see why it's a problem, because a lot of investment decisions require a lot of judgments, right? Now let's say, for example, you as an investor, you bought a stock, and now you are holding on to a stock for a more longer period because you have anchored it on the higher price, right? The buying price biases your judgment about the stock's true value. So I'll give you an idea. Every time when I buy a stock or when I sell a stock, I need to understand this thing, that whether, if I'm entering into this stock, is it the right price? So if you started tracking Apple stock from today and you see it is at $170 per share, so all your investment decisions will be based on that it was $170 today, now it has gone up to 180. Came down to 170, 180, 170, 180. The moment it goes below 170, it might trigger you that now, okay, now it's cheap, let's buy. Little do you know that Apple price 1 year ago was 120, so it might be going towards the yearly low also. So this is where the anchoring bias comes in. The only way, and we have to understand this, that it's very bad as a bias because you don't know the full information. You just put your foundation where you started from. You have to have a proper information, and how you can actually overcome this situation. Take your time to do research before you make a decision. Make a comprehensive assessment of a price of a stock and understand how over a period of years the prices have moved. We be very open to the new information. Even if it doesn't align with your call, please be very open to the information. That is something which is really, really important, because that affects us, right? So always understand this thing, that we should be open to the idea. Now imagine, there is anchoring, right? That's one. If you see another bias over here, which is called herd mentality. Now herd mentality also, it is so common, and as the name suggests, everybody becomes the victim of herd mentality, because sometimes we don't have the time to look into what's going on. And it basically happens when investors, they follow others rather than making their own decision based on actual data and reports. Wherever your friends are investing, if your friends are investing into garbage stocks, you will end up investing into garbage stocks, even if you feel that it's risky. But just because your friends are investing and you are also investing in, that is called herd mentality. And we need to understand this, because why we follow a group of people? Tell me, anybody can tell me the reason that why we follow a group of people rather than doing our own research? Like, if 10 people are doing it, why would I actually do the same thing what other people are doing instead of basically trying to do on my own? What do you think? Think about it. Okay, we started getting a few answers. Great. Uh, okay, okay, okay. So a lot of people said it feels a lot more safer. Precisely. Why would you do it? Because it feels a lot more safer, right? If 5, 10 people are doing it, then it becomes, you feel you follow a herd. Because first, there are two things. Somebody just wrote FOMO. FOMO means there is a lot of fear of missing out, right? You feel that my colleagues, my friends, they might end up making money, but I will be the only one. Let me also do it. Like what happened with a lot of cryptocurrencies, right? Everybody investing in cryptos, buying cryptos left, right, and center. People who don't know what cryptos are, they don't even know how much risk it contains. But because they had fear of missing out, they just followed that herd mentality. Everybody's doing it, I should also do it. So, because it feels safer, because you also have the fear of missing out, you end up just following what your friends are doing. So that is a problem. Why it's a problem? Because it can backfire. This create bubbles, like what happened with .com in 2000, 2001. Everybody would just buy tech stocks left, right, and center without even seeing that a lot of companies which went for IPO with a .com in their name were not even tech companies. They were restaurants just taking advantage of investors, right? So understand, following herd mentality leads to bubbles in the stock market, and eventually everybody loses money when it bursts. How you can actually overcome this? Just step back and try to look investments carefully. Look into the company's fundamentals, see how their balance sheets are, see if it actually looks like a solid investment, and be very skeptical of what you hear around. Always, because a lot of investment there these days, everybody just takes up a podcast mic and starts doing a podcast on Instagram, right? So we have to understand that not every influencer is right, not every person who is having a black background and running his mouth on a podcast is right. Even what I am telling you, I'm not asking you to blindly follow me. That's why I keep telling you, do your own research, read about the behavioral biases, and you will find out that whatever I'm talking to you, it makes a lot of sense. Because as an investor, last 15 years, I have been into this emotional roller coaster and seen that what emotions can do. I have been the inside that process. I have been a victim of it. I have been a learner of it, and now I am following that. So all of us go through this journey, but the only worst part is when you don't learn from your mistakes. That's where the problem comes in, right? So again, as I said, these biases are very common. Like for example, if we were to discuss one more, loss aversion, as we see, because loss aversion is something which is again very common. Basically, as an investor, you try to avoid losses over seeking gains, right? And the biggest mistake, financial mistake, people who make is taking too little risk or not too much risk. That's the biggest mistake, by the way. Your risk, if it is too little or if it is not that much. So loss aversion is because, and that is reason because you're averse to losses. The losses hurt you more than the gains. And that's the problem. Why it's a problem? Because it causes us to avoid small risks even when they are probably worth it. So people would save rather than invest, even though inflation will erode your value completely. It will destroy your savings, but you want to hold it for long enough because you feel that what if I lose money? Right now, every single person right there who is listening to me, if you are keeping cash with you or in your bank here, you are not don't feel that you're protecting your money, because inflation doesn't stop. So if you don't invest, eventually the value of your money, it gets eroded. This is loss aversion. The surest way to build wealth over long time horizons is only to invest in a diversified portfolio of common stocks. You pick your stocks, not that every time you. The only way that your money can grow is when you invest into different businesses, right? Or when you invest into different asset classes. That's how the money grows, right? So someone with a longest time horizon shouldn't have exposure to low risk. Like if you know that you can keep this money for 10 years, then invest into good companies, invest into businesses which you feel can become something, right? How you can overcome this bias is basically don't just leave it up to the emotion. Create a strategy, stick to it, make a mental effort to adopt some risk by considering assets that typically perform well, right? S&P 500, see, just to give you an idea, because we are talking about it, just look at it. See, sometimes, let's say, for example, here, SPX 500. If I were to give you an idea, see, now I'm looking at a very long term chart of SPX 500, okay? I'll go back as much as I can. 2007, yeah, okay, 2007. I'll show it from here. Look at this. 2007 it went down. Now from 2009, 2008, S&P 500 has gone only higher, right? Now it came down again, going higher. Now obviously you will tell me that inflation also came up. Exactly. So stock index also went up. The idea is that if all this while you have not invested into SPX 500 and kept money with you, then your money has eroded in value while the S&P has continued to move higher. There have been bumps on the road. It has come down, crashed, pandemic happened, war happened, everything. But eventually it continues to go high. So the idea is that your money needs to be invested, right? But with loss aversion bias, you try to always be out of the market. You don't invest into it. So always don't leave it to the emotions. Always stick to a plan and do that. That is something which will keep you away from the loss aversion, right? So these are a few biases which I wanted to discuss it with you. And as you can see that there are different phases of the market. There is peak, there is contraction, there is recession, and this is where is the problem. We end up buying at the top peak, and then when the market starts going down, you only start regretting, and when it goes down further and you feel that you cannot hold it any longer, you sell it off. The moment you sell it off, market starts going higher, again you are into regret and you don't do anything. Then again when it reaches to peak, you feel that I missed an opportunity, let's buy now. Again the market comes down. So this is a very horrible cycle, and that's why you need to keep your emotions in contact. You need to be talking to your risk consultants, you need to be talking to financial consultants and understand what's the right time to enter and exit. And when I say right time to enter and exit, obviously we are not going to time the market. We need to understand the risk and reward. If the market is at its peak and when you end up buying, you have to understand that the smaller portion is enough. If you were to invest $100,000, you see markets are at its peak, start with 20% of that. If it comes down, enter 20%. If it comes down by 20%, that will allow you to do dollar cost averaging, right? Or do SIPs also sometimes. It is always beneficial. And then trading position, never add to a losing position. Always determine a stop loss, always determine a proper profit objective. It's very important. Never make a judgment when you have a trade. Once you have entered into the trade, you have put your stop loss and take profit, that's it. Your decision to exit a trade means you perceive changing circumstances. Don't suddenly think you can pick a price and exit. You give yourself a range. If you have given yourself a range that this is my profit, this is my loss, stick to it. A disciplined routine, determine your trend, look at support and resistance, have your approach. You want to go long term, you want to go short term. Stick to risk and reward ratio, right? Accept that there is a risk and make a trading plan, make a trading journal. I always tell everybody, write in your notebooks that why you have placed a trade, what is the reason you have placed a trade. That is also something really important, right? So, guys, as I said, these were the few things which I want to talk about. Thank you so much for giving an hour of your time. I'm sure that you must be doing a lot of better things rather than sitting here and listening to me. But then, as I said, these sessions we do are for information purposes, and we will be more than happy if you want to come sit with us, discuss these sessions one on one, and we can definitely assist you with it. There are a few questions I would like to answer. I think a lot of questions are coming in, but I'll select a few of them. Where do you think S&P 500 is heading to? See, at the moment, markets have gone higher, but tomorrow is the inflation data. You can check in your markets calendar also. And tomorrow, inflation data will decide where central bank is moving to. A month ago, a lot of analysts were expecting that Fed was done with rate hikes. But after oil prices bounced back, it is anticipated that inflation might have increased. And central bank has clearly announced that they would want to have inflation under 2%. So we are expecting around October, we might see S&P 500 coming down a bit. So be very careful at the moment. It looks like the markets are in a bearish trend, but a lot of information can be achieved by looking at the economic data tomorrow, right? Uh, where is it wise to put money into growth stocks now? Good question again. A lot of my clients ask this because growth stocks are basically tech stocks. It depends on how what's your approach and the investment horizon. See, if you are ready to hold these stocks for another 3 to 4 years, because industries like electric vehicles, industries like hydrogen fuel, these kind of industries would develop in the next 3 4 years. But currently the companies which you see, like to give you an example, Plug Power, it's a good company, but a year ago it was $30 and right now it's at 13. And this is it's a good company to invest in, but the only thing is the sector which it is in, it's very aggressive. We are talking about hydrogen based fuel, and it's one of the only companies which is providing that. And that is the reason that why the stock has a lot of potential, because the revenue has grown more than 8 times over past few years. But because the interest rates are high, so tech stocks have fallen down. So there are some good companies. You can talk to our financial consultants. You can talk to our risk experts also. We can definitely filter out a few good tech companies. But please understand that tech at this point of time is going to be very aggressive. So if you are ready to take that risk, as I said, that you need to diversify your portfolio. Your one part could be into tech stocks, but second part could be into dividend yielding stocks as well. Have a diversified approach, and I think yes, definitely you can invest into tech, because central bank has almost peaked out on the interest rates. Maybe a few more rate hikes, not very aggressive. Eventually you will see that even Nasdaq, year till date till now, Nasdaq has gone up by 30%. So tech has done recovery, and I think coming up with quality names or sticking with quality names is only going to help you to build a better portfolio. So go with a part of the tech should be with stronger companies like Amazon and Microsoft, and a part of tech companies should be with the emerging sectors like an EV, ChargePoint or Plug Power, or in cybercrime solutions like Okta or Zscaler, these kind of companies. So definitely, yeah, I think we can always sit and chat. Can I get a demo account? Definitely, you can get a demo account. Just talk to your RMs and they will give you one. So that's something which is very easy. Try these portfolios and strategies in your demo accounts, and we can definitely do this. How often you do these sessions? We do these sessions every week mostly. Sometimes it's me, sometimes it's Mr. Vivian, who's a technical analyst. So we cover both fundamentals and technicals. Sometimes there are investors who are interested very much in charts and candlesticks. So we do a session for them as well. But that being said, we are based in Emar Square. So anytime, please, if you want to come over and discuss these things, we are more than happy to teach and train you. This is something which we do as a part of our introduction. So whether you are a client or not a client, we are more than happy to teach and support you. If you have any questions, any doubts about investments or how these things work from the ground level, from the very scratch, we can definitely teach you how this is done, right? So I think perfect. Most of the questions feel answered over here. And if you have any more questions, I'll be more than happy to assist you. My name is Yogesh. We'll see you next week with a different topic. Until then, thank you so much for giving out your time today. And I hope that the session, whatever we have discussed today, it's worth your time. And I'm sure that any one of you who is going through any sort of these behavioral biases will definitely get more and more information and work on it, improve on it. And I feel it's really good to share ideas and information. So please, let's try to get become better investors, better traders, keep our emotions in control, and continue to put stop losses, continue to have more and more strategy based trades. And last but not the least, let's continue to speak to our financial consultants and take their opinions also when we invest, right? So once again, you have a good night. My name is Yogesh, and we'll see you next week with a different topic. Thank you so much.